Good afternoon and welcome back, everyone, to another episode of the Market Playbook. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and I'm joined here by Jessica Inskip, our Director of Education and Product. Jessica, we have a fantastic session here today, something quite different than we normally do, a really Ask Us Anything session. And hundreds of you have submitted your questions, and I think we had over 500 plus questions submitted to us, and we're going to try to get to the questions that we think are going to be most beneficial to the widest possible audience, talking about option strategies, talking about our backgrounds, talking about how we think about trading, and try to give you some insights that you're going to be able to take away from today's session. We have a lot to cover here today, so I'm just going to go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we may use as educational examples during today's session. Like I said, we have a lot of questions to get to, but before I jump into it, I do want to address one thing that I think we've gotten a lot of questions today, which has really been on the back of the CPI print. We've had a very, very big move here. The S&P 500 up nearly 5%, the NASDAQ 100 up nearly 6% on the back of the CPI print. Jess can talk a little bit about the inflationary numbers and what they mean, but from my perspective, when I look at the S&P 500, one of the important things that we have seen is that it's now broken out above an important level, 3,900, which is the level that we traded against. This was the top of the weekly cloud. We broke out above it. It also happens to be some major support and resistance over the past few months, a real battle level between buyers and sellers that has been breached here to the upside. And that really changes the tone here of the broader markets to being a bit more bullish here into the bottom of the cloud, into that 4,100, 4,200 level here to the upside. So that has been the major shift here. Not only have we seen a shift here from equities, we've also seen a shift here from bond markets. The bond markets have shifted their expectations as to how far they believe that Chairman Powell will have to raise rates in order to fight inflation. Before today's CPI print, we were looking at about a little over 5% as the terminal rate on the Fed's movement of interest rates. Currently, that's moved 25 basis points lower to 475 to 500. So we've seen a shift here in the terminal rate. That's going to likely shift the path to that terminal rate and how far the Fed needs to raise interest rates in order to, quote unquote, fight inflation. So changes in that expectation from the bond market has reflected in the equity markets at the moment, and that's currently where we see. So huge sentiment shift off of the CPI print earlier today. So Jess, why don't you talk a little bit about kind of the inflation print and kind of why markets reacted the way they did today?
Absolutely. So it is certainly the word of the year is inflation and interest rates. And I know we've had a lot of market playbook sessions where we talk about the key contributors to inflation, and I think that's important as well. But the market loves to hang on to any thought of a Fed pivot or the thought of Powell or the FOMC being less restrictive. And that's what we see happening here. Inflation cooling off, signs of that causing this amazing, immaculate rally. And then on top of that, there was a decline in wage growth. So what I think is important to be cognizant of is one, CPI is a lagging indicator, and it's lagging by about 6 months or so. So there's a lot of data that has to come into that. And it's the best representation that we have of all of the goods and services, not just one specific index. It's a compilation of indexes. And Powell himself has said that he wants to see consistent data, but he also stated on his last speech, and I think this is extremely important, that he is relying more on forward-looking indicators, which CPI is not. So I think that's just important to think of and try to understand as really, I'm trying to understand the person who is making these decisions. That's really important to understand the mindset, what data they're looking at. And that also relates to the job market. So he says quite a bit that there is unbalance in the labor market, and that's just of supply and demand. And I think some of that could be resolved depending on outcomes of midterm elections and things of that nature. So watching job data is extra important because Fed himself has said an unbalanced labor market. So Yes, there has been a rally based on cooling CPI data, but I would like to see consistent data. Was Fed speak even this morning, where she came out and said, we are still restrictive. We are maintaining our hawkish stance, but still the market rallied. But we've got time, and unless there's some other large event until December, and there's a CPI print the day before the next Fed announcement. So between now and December, there is potentially room to rally based on that hope of a Fed pivot, and then we'll see what happens on that next CPI print, the data that comes in between, and what Powell will do.
Yeah, this is definitely the first time we've really seen the market's actually pricing in this quote unquote Fed pivot. That's kind of what we're starting to see. So we'll continue to update you on developments here in terms of how equity markets respond to this. Do I think that this shifts the long-term picture here for equities? I don't think so, not yet, not until the S&P 500 breaks out above some major resistance levels, predominantly this trend line that has been in place. So as you can see, we're going to be touching up against that trend line in the bottom of the cloud if we rally another 4 or 5%. And if we break out above this and above the cloud, that's really when things really shift in terms of tone. Otherwise, we're still very much in a bear market. So hopefully that gives you a bit of context here in the broader markets. On the back of the CPI print. But like I said, over a few hundred of you have actually submitted questions. We had over 500 questions. It took us a lot of time. We actually ran out of some time sorting through all the questions, trying to figure out the best ones to try to answer. And there are so many of them. I'm not sure we're going to get through all of them, but we're going to do our best to try to get through as many as possible. So we're going to start off with a fun one. We're not going to talk about options. We're going to talk about what's your educational professional background? Richard's asking. Actually, there were quite a few people asking this type of question. So I kind of summarized it into one question, but what's your educational professional background before entering options play? Not everyone has a finance background. Even finance is a very diverse field. So I'll answer this first and I'll give Jess a chance to answer as well. My education background does happen to be in finance. My professional career started as a broker at a firm called Forex.com. For those of you that trade currencies, spent 7 years there. And that's really where I learned technical analysis, futures trading, options trading. Being able to trade all three products using technical analysis was formative in my career. And I had the opportunity to start options play about 10 years ago. And I took that opportunity to try to create a better experience for options trading for everyone. And that's kind of how I ended up here. But I will say, I didn't learn a whole lot in my finance degree to what I'm doing today. I would say that what I learned in school was fairly limited compared to what I learned on the job over the past 16, 17 years of doing this. So that's a little bit of my background and kind of how I ended up in the seat that I am today. Jess, can you talk a little bit about kind of your background, your education, and how you ended up here?
Sure. Yeah, my degree is in business and organizational management, so not finance at all, but actually makes sense if you think about what I do in the grand scheme of things. I got into finance because I thought I was being clever, getting an internship my first year in college, and I found one that was paid, and I got college credit at the same time. So that was just me. Didn't know I'd fall in love with it, but then I really got into options. And that's a long story we've talked about before, but then I worked at a lot of different brokerage firms. So I was actually the first female in the active trader desk over at Fidelity Investments. That's where I learned the most, I want to say, about options trading, because they have a really great trading program where they literally put you in a room and they hot seat you and you're required to answer like this. And it's designed to literally make you cry, but I don't do that. Aside from that, I spent a lot of my career at Merrill, where I actually ran the strategy for the advanced trader, they'd call it, or the engaged trader. And there is where I also applied a lot of options concepts. So a variety of roles, found myself having a lot of legal risk and compliance processes as well. So it's really well-rounded for what we do at OptionsPlay.
Well, we are lucky to have you on the OptionsPlay team, I will say.
Thanks, Tony. Happy to be here.
I'm going to go through these questions as quickly as possible because there are so many to try to get through. And I'll go through some of these quickly because they're fairly easy to answer. How does the platform define if a stock is liquid or not? Can you expand on this criteria? So Benito's asking this question because on the OptionsPlay platform, you can actually see liquidity. We have 3 rankings: very liquid, somewhat liquid, not very liquid. And the question is, how do we rank this? We typically use 3 indicators for this. We use open interest, volume, and bid-ask spreads, the size of the bid-ask spread. And we look at all 3 components to try to measure whether a stock, or rather an option, is extremely liquid, somewhat liquid, or not liquid at all. There's about 200 to 300 names that we consider very liquid. There are 500 to 700 that are somewhat liquid, and the rest of roughly 4,000 names are not liquid at all. So out of the 5,000 names that you can trade, only about 1,000 names we think you can really trade options on. 4,000 of them we would not touch from an options perspective. So hopefully that gives you an idea as far as liquidity and what that actually means. The next question here is for Jess, and she's saying, and the question is, say an option is in the money. How can I reduce the chances of assignment by rolling it to a further expiration option? Isn't it still in the money after the rolling, and doesn't that still carry the same amount of early assignment risk?
Yeah, so your likelihood of assignment, one, the only way that you can remove that risk completely is by not holding that short option. But what happens is if it's in the money and does not have any extrinsic value. So remember, with options pricing, you have its executable value. So it's a call that has a strike price of 100, the underlying is at 110, that has intrinsic value of $10. And if the premium has any excess, so say $2, you have less likelihood of assignment because it wouldn't make sense for the person on the other side to execute upon the terms of that contract. So the only way to ensure that you don't is by A, not having short option, or B, or the preferable method is you do a quick calculation of understanding if there is any extrinsic value. Now, when you roll your option, you don't only roll it to a later expiration date. In this case, depending on what it is, you'd probably want to roll it up or down. So for a covered call, you'd want to roll it up so you can account for more capital appreciation, assuming you are still bullish on the position. So know that if it's in the money or not after rolling, that depends on the strike price that you choose. And normally when we roll, we wouldn't want to keep it in the money at that point because you're capping normally risk potential, or depending on the strategy, your gain potential.
Thank you so much. And just to add to that, even if you do keep the same strike price that's in the money and you roll it further out, you are further reducing your chances of early expiration, because the larger the extrinsic value, the more that the option exerciser is giving up to exercise that option. And the larger the extrinsic value, the more they're effectively giving away free money, and makes it less economic, it makes less sense for them to exercise an option that still has plenty of time left to go. So hopefully that answers your question. The next question here is from Ben, and Ben's asking a great question. He's saying, when using the wheel strategy, what should one do if the current price of the owned stock is much below its purchase price? Now, this question isn't just for the wheel strategy. This is really for anyone who's selling a cover call. And the question is basically, if your cost basis is significantly higher than where the current price of the stock is, should you still proceed to sell a call at a price that's below the purchase price, but provides quote unquote decent premium? And this is a really good question because you run the risk that you end up selling your stock at a loss, but you're generating some income in the short run. So this is really where the answer to the question depends. And from my perspective, the dependency is on whether or not you want to hold on to this trade as from a capital perspective, because the way you think about a losing investment, right? And this is a stock that you bought at, maybe you bought at 100 and now trading at 50. The way that you have to think about this is, is this the best use of your capital, right? The $50 that you have left per share in this particular stock, is that the best place that you have for that capital? Meaning, do you feel that this stock now has strong a strong possibility of appreciation over the next 3 to 6 months? Or do you think there are better stocks for you to put that $50 a share into? And that's really the question that you have to ask yourself. I can't answer that question for you. It really depends on why you've invested in this stock, because if you believe that there are better opportunities for your money in other stocks, meaning other stocks that will likely appreciate in value faster than the stock that you currently hold, despite that it's at a loss, then I would advocate that you should start selling covered calls on it. Because one, it's going to start generating an income stream for you immediately. And you want to sell relatively conservative calls. Sell 10 delta calls, stock where the stock has to take a big move here to the upside in a single month before the stock gets called away. Because then you're basically taking advantage of a big move, taking profits from that, even though you're quote unquote at a loss from the original cost basis, but taking a profit for that month and keeping some income. And that now you're going to be able to take that profit. Maybe you sold the stock at $60. Take the $60 a share and buy a stock that you think has a better chance of appreciation than the stock that currently is clearly not performing as well as you originally intended to. So it really is contingent upon that. But I will, Jessica, do a shameless plug here for our session that we're hosting next Tuesday. Jessica and I, and along with Prakash and Rick, we are hosting a masterclass on the wheel strategy. This is something that we are offering a 50% discount to everyone who's watching today's session. The promo code is AMA. You can point your phone cameras at that QR code to sign up for the wheel course, the wheel strategy master course that we're running next week. For those of you that joined us for our bear market course last month, it's going to be in a similar style. It's about 3.5 hours long. We're going to really deep dive into option selling, the wheel strategy. I'm going to talk about managing it, and Rick will talk a little bit about technical analysis and how to find stocks for the wheel strategy. So normally this course is $199. We're offering everyone who's viewing this course here today a 50% discount, so only $99 using the promo code AMA. I believe Philip has sent everyone the link into the chat window if you want to sign up using that promo code. The promo code, once again, is AMA. The session is going to be on Tuesday from noon to about 3:15, 3:30. And again, it's a half-day intensive session for those of you that are interested in the wheel strategy. And yes, it will be recorded. So if you sign up and you can't attend, you'll get the recording with the slides after. So just a bit of a shameless plug for our master course that we are running next week. So hopefully for those of you that are interested in selling cover calls, cash secured puts, or interested in the wheel strategy, you can find some value in that particular course. We've put a lot of effort into putting this together because so many of you have asked us questions about the wheel strategy and how to kind of implement it. So we've decided to do a very deep dive into all the elements that you need in order to master this one strategy. So, question for Jess: why trade options over stocks? This is a great question, and this is a broad question that I think is applicable to a lot of investors.
Yeah, and I didn't even put it in this order, so I think it was a great order even. But yeah, so you probably start trading stocks and you have to understand the pricing mechanics of options and that you're adding complexity to your trading process. But options can enhance your stock portfolio first and foremost, but you can also utilize options to buy and sell stocks as well. So that's one component of it, but also options fall in different types of categories. So if you can utilize options as long as you understand how they work in a neutral, bullish, or bearish environment. That's why they're extremely, extremely helpful. So not only can they enhance an existing portfolio from the stocks that you already own perspective, but you can take directional views. Now, if you think about shorting a stock, that has unlimited risk potential and can go against you very easily, requires a lot of capital, margin calls and things like that. Whereas options provide a limited risk, if you layer them appropriately, where you can take a bearish directional view on the market and capitalize very similarly to you would with short stock, but with less risk. So why I trade options rather than stocks is I might still trade stocks too, but I utilize options as my entry point. And you can utilize limited risk and appropriate diversification, just like you would teach in a stock portfolio, just with taking directional views. So really it's limited risk, leverage, adding income to your portfolio, and enhancing what you already have.
I think that's a really good point. I'll just add to that because even if you're not interested in trading options and you're just a stock investor, options can help you enhance your stock investments. And that's really kind of how you should think about this, right? Options can either be a tool to help you reduce risk or it's a tool to help you add income. And those are the
Mhm.
two predominant uses of options. If you're using options purely as a way to leverage your capital, I can't help but think that that's not a sustainable strategy in the long run. I don't think any customer who's or any investor who's only buying options purely for the leverage will come out ahead in the long run. And that's just simply because options are priced higher than where they need to be perfectly honest. And that's why we predominantly sell options. There's a lot of options selling. And even when we're buying options, we're selling options to offset the options that we're buying. So when we're using a debit spread, why are we selling that upper strike? Is because to reduce the cost of buying that at the money call or put. So keep that in mind. Options is a tool to help you reduce risk and add income, even if you're just a stock investor. The next question that I have here is from Junji, and this is a great question. He's asking for cover call selling. Will selling weekly cover calls and continue to roll each week during the day when the stock price goes up create more income than selling a 30 to 45 day out cover call outright? Have you back run this model? So Junji, we've actually back tested this model heavily, and it's not just for cover calls. We've done it for credit spreads, we've done it for iron condors, we've done it for strangles and straddles, we've done it for every single option selling strategy. And this is really where academics and practical and the real world merge, and you start to see significant differences between theoretical and the practical world. Because theoretically speaking, selling weekly cover calls will generate more income. Practically speaking, in the real world, it doesn't translate to real world results. And there's two primary reasons. The first one is transaction cost. And not only transaction costs from a commission and fees perspective, but more so from a from a bid-ask spread perspective. Because every single time you're entering or exiting, you're paying the bid-ask spread or some portion of the spread. That's going to eat away into the marginal gains that you're getting from selling weekly cover calls or weekly options versus selling a longer dated option. But the second primary thing about selling weekly options is that let's say over a 45-day period, you're able to sell 6 weekly options. What you're doing is you're increasing your chances of early assignment 6 times higher than if you were selling one 45-day option. And that chance of assignment is really what screws up your potential gains for this, or the marginal gains that you can get from selling these types of calls. Because imagine if every single couple of weeks your stock got called away and you have to now buy the stock back and then sell cover calls again. That new transaction cost that you're adding to your portfolio is significant. And you're also adding a lot of complexity because instead of having one chance of early assignment, or rather assignment every 45 days, if you have a chance of assignment every single week and you have to manage that appropriately, you start to underperform the strategy in the long run. So that's really the difference between academics and practical in the real world that doesn't quite translate. So we've done the back test, and this is part of why 45 days out is where we start when selling cover calls, when selling credit spreads, when selling iron condor, straddles, and strangles. It's because of this difference between academics and the practical real world. Hopefully that answered your question, Junji. The next question is from Mitchell for Jess. And Mitchell's asking, can you please explain the interplay between the prices of the underlying stocks themselves during the day versus the trades on the ETF itself in terms of how an ETF's price and options price move during the day? I.e., does the trading in the ETF move its price, or the total / average, et cetera, of the trades on the underlying stocks, XLF, for instance? This is a really complex and deep question that I think Jess is specifically suited for answering.
I actually loved this question, so I immediately pulled it. Yeah, so ETFs, it all is a function of supply and demand from a lot of aspects. So ETFs have an NAV, net asset value, that is calculated once a day, and it can trade at a premium or a discount in comparison to the underlying securities that are made up within that basket or that ETF has. Now, when it is trading at a premium or a discount, that is adjusted so on a daily basis, so coming back to its equilibrium through something called arbitrage. So if it is at a premium, there will be a creation of shares that will influx supply and then push it back down closer to NAV. So it can, for a very brief moment, be higher or lower than the actual shares that are within that security due to, if there is a lot of buying in that ETF, the natural supply and demand functions of the market. But that's also normally happening with the underlying securities themselves. So that is a really, really great question. If that's something that you want to mitigate, because there are a lot of ETFs that do the same thing, like SPY and VOO, that does the exact same thing. And if you wanted to compare them, you look at something called tracking error, and that will tell you how much it deviates from its actual net asset value. And normally there is a little bit due to that supply and demand change on a daily basis. So I loved that question, completely grabbed it. As far as from an options move during the day, completely different process. And that goes into options pricing. And so I'd recommend that you go watch that video found on our YouTube channel on understanding how an option is priced, because we talk about that for an absolute hour. But it's the option will move based on the underlying security, regardless of the NAV for an ETF anyways. But there are also extrinsic value components that we've been talking about throughout this. So that time value and implied volatility. So that's why the underlying, when your option doesn't move in tandem with the underlying security. So there are really two questions in there. But I loved the question of maybe the ETF moves more than some of the securities did. And the reason is somebody literally could just be bidding them up, and that is it. But it is always reset through the arbitrage process.
Yeah, and when things are super liquid like SPY, XLF, you will have plenty of people who are trying to arbitrage that out. But this really depends on the ETF. You have some commodity and bond ETFs that consistently trade at a discount or premium to its NAV. You have some REITs that trade consistently at a discount to its assets. So it depends on the ETF, and also depends on the liquidity of the ETFs, because some of the assets you can't arbitrage. You can't really arbitrage, properties, if you will, with an ETF. So some of those consistently trade at a discount or a premium to its NAV. The next question is a really good question. And this is a more theoretical question, but I think it's a great question for a lot of investors who are thinking about getting into options, or maybe thinking about how to position their portfolio with options. And the question is it possible to sell options for a living? And if so, what's a good starting quote unquote bankroll? And how would you approach selecting which stocks to start with? So I think, there's a few different components to this, right? First, is it possible to sell options for a living? And the answer is absolutely yes. However, there are two things that I think are very important to doing this for a living. One, you need to have a strategy that you really feel consistent with. Whether that's selling credit spreads consistently, whether that's selling straddles and strangles consistently. I would argue that when you look at professionals that are doing this as an option seller, they're predominantly using strategies like straddles and strangles, because that's really where you're going to be able to collect the most premium. And actually, even those straddles and strangles theoretically have the highest amount of risk, because they both have unlimited risk. It's actually the strategy in the long run that shows to have some of the fastest recoveries from drawdowns because of how much premium you're collecting. So the second part of this question is, how much do you need to bankroll this type of strategy? So with straddles and strangles, you need a large amount of capital. Minimum, in my opinion, $250,000 to start. Now, is that enough to make a living off of? I guess that depends on how much you need in order to make a living. But just from a risk management perspective, anything less than $250,000, you're going to be starting to spread out your risk too heavily in a single month, where you could end up blowing up a good chunk of your portfolio selling straddles and strangles. You need to have at least $250,000 to basically be able to survive through the losses of selling straddles and strangles, because you are going to have losses. But what you need to do is consistently continue to sell those types of strategies, even through months of weeks or of losses, because some of the times when you have big losses in selling straddles and strangles, that's really the best possible environment to be selling straddles and strangles. And that's how you recover. And when I refer to, the fastest recovery from a drawdown, it's because when you sell a straddle and a strangle and the stock moves significantly higher or lower, well, implied volatility now expands, and that's a better environment for you to continue to sell straddles and strangles. But emotionally speaking, that's really where a lot of retail investors shy away from risk, right? You sell a straddle and strangle, you see this huge loss in your portfolio, and you say, this is not for me, I gotta stop. But professionals who have been doing this and have been doing this for a long time know that that's the best time to get back into that strategy and continue to sell straddles and strangles. That's how they're able to get themselves back to break even as quickly as possible. But in order to do that, you need to make sure that each straddle and strangle you sell is accounting for a very small percentage of your portfolio, so that even those large losses are still accounting for a relatively small percentage of your portfolio. So the rule of thumb here, from my perspective, is a minimum of $250,000. I think comfortably you need to be in the $500,000 to $1 million range in order to quote unquote sell options and do it for a living, and basically and not have a full-time job in addition to that. As far as how do you select stocks to do this with, high implied volatility stocks, high IV rank, very liquid. That's really where I start. If you think about 200 to 300 very liquid names and you think about which ones have high implied volatility, you're really looking at a handful of names at any one time that you can be selling option strategies on. So hopefully that kind of gives you a comprehensive view to your question. The next question here is for Jess from Dave, and he's asking, Tony and Jessica, I've been rolling calls every 30 days or so for the past few months on a stock that's been trading about 20% above my call strike price. $100 call, but the CMV is at 122. Each time I roll at the same strike, I collect additional time premium. I don't see any reason to have the stock called away. Am I missing something with my strategy? So this is a question asking, should I continue to roll my in the money cover call, which is an interesting strategy. So Jess, I'll let you weigh in on this first.
Yeah, so I think it's an interesting question, and actually one that I've seen throughout my entire career. So that's why I want to make sure that we absolutely address it. So first, I'm going to address the question directly, and then we'll add a lot of color. So like we were saying earlier, your risk of assignment is extremely high if there is no extrinsic value. Extrinsic value is centered around at the money options. So the farther that your option goes in the money, the less extrinsic value that it's going to have regardless of expiration, because of where theta is centered. It starts acting like the stock. Now this might be close to that, but what this tells me is because you're selling a 100 call, you still have some extrinsic value, but it's not as much because it's deeper in the money. Now I think part of this is a psychological aspect. What you're doing here is you're giving up capital appreciation. You might say, oh, well, buying back 100 strike call, I know is going to cost you at least $22 because that's where CMV, if it has the right to buy 100 and I can sell the market at 22, and whatever extrinsic value is there. And psychologically, that seems like it will be a loss, but it's actually not, because what happens when you're selling a 100 call, you are obligated to sell CMV at $100. And so that $22 worth of capital appreciation is gone, and it should be reflected in the price. But so what I'm trying to say, and hopefully I'm saying a little more eloquently, is if you were to have a higher strike price to account for capital appreciation, not only one, would you find more extrinsic value because it is centered around at the money options and goes away as your option gets really deep in the money. And this is a deep in the money option. You can collect more extrinsic value, but also allow capital appreciation that will remove your risk of assignment because it's not in the money. And it is a best practice, especially with a covered call, to prioritize capital appreciation, because what happens is you take a individually bearish position, which is a short call, and turn it into a bullish position. And so you want to allow yourself movement up. I am sure you want to add color to that one, Tony.
I do, because this is something that we get a lot of. Surprisingly, we get a lot of questions about in the money calls, and I'm not sure why, but we do get a lot. And from my perspective,
they're more expensive. It's psychological. You think you get more premium when you don't.
It is 100% psychological, because from my perspective, there is virtually zero reason to sell an in the money cover call. this person's asking, I don't see any reason to have the stock called away. The only reason that you would not want to have a stock called away is because you think the stock's going to continue moving higher. But by selling an in the money cover call, you have no capital appreciation. Even if the stock goes to 300, you participate in $0 of that. So if you have zero capital appreciation to the upside, why hold on to the stock? The only thing that you have is downside risk. Granted, when you sell an in the money cover call, you have some downside risk protection. You have downside risk protection down to 100. But if the stock drops below 100, you are now taking risk to the downside with absolutely no reward to the upside. So from my perspective, there is zero reason anyone should be selling an in the money cover call. If anything, you want to roll this to an out of the money cover call, because now you're collecting premium, you're collecting extrinsic value, which you're not doing today, or virtually very little extrinsic value that you're collecting. So you're getting very little income from the strategy, and you have no capital appreciation. If you instead roll this to, let's say, a 130 strike, now you have $8 of capital appreciation, you have more income coming in, and that help offsets the risk that you have to the downside. So that's my view here, and it's very, very clear, black and white. There is no reason to sell an in the money cover call. Next one, what is the benefit of a strangle over running a wheel strategy? So I would say that the two strategies are very similar in nature, right? Because a strangle is really half of the wheel strategy. You're selling the cash secured put, or rather you're selling the put side and you're selling the call side as well. The benefit of a strangle is that you're doubling, close to doubling the income of the wheel strategy, but you're also significantly changing the risk profile, right? Generally speaking, when you're selling a strangle, you don't want to be assigned. When you're selling a wheel strategy, you want to get assigned. So it's a matter of whether you're looking to be you're just looking to take the cash that you have in your portfolio and trying to generate as much yield as possible. That's what the strangle strategy is for. Or if you're trying to take the cash in your portfolio and put it to use in a long-term investment, buying an ETF, buying a stock that you think is going to go higher, that's what you want to use the wheel strategy for. So hopefully that answers your question, Paul. I don't know, Jess, if you have anything to add to that.
Well, you always cover everything so well. Yeah, I'm thinking if you have you're going to enter into a short put to create your long position with the wheel strategy. And if you are doing a strangle, you're going to have a short call, probably at where you think it's not going to go. So if you're truly bullish on a position is what you would do for a wheel strategy, what you're doing is you still retain your substantial risk profile equivalent to owning the shares, but then you've added an additional unlimited risk profile to the upside as well. And so if you're bullish, it almost doesn't make sense in that aspect. It's the only color I would add.
Okay, thank you so much. We're going to try to fly through a few of these, and Jess, if you don't mind, I'm going to skip a few because I think some of them were quite similar in nature. I'm going to try to do my best to get through as many as possible. There's a great question here on a credit spread, and there's been a lot of questions as to how to manage credit spreads, on a take profit and stop loss side. So the question was, a credit spread strategy says close the trade at 1/2 of the max profit and 2 times the max profit. Suppose we have a trade where the max profit is 100 and the max loss is 150. What should the max loss be set to in this particular case? So what that means is that you're collecting $1. That's if the max loss of something is $100, then that means that you have collected $100. In this particular case, what you want to do, or rather $1 per share, what you want to do is you want to set your stop loss at $2 a share, right? Because if you sold something for $1 that's now trading at $2, you've now lost 100% of the premium that you've paid, or what you call twice the premium that you collected, right? That's why two times the max profit. That's how we get to $2. In this particular case, this is a $2.50 wide credit spread. How do I know that? Is because if you have a max loss of 150 and the max gain is 100, adding those two together is 250. So what you're basically doing is saying that if you sold something for $1, the most you can lose is $1.50, meaning if it trades to its max loss, $250, that's your max loss. But what we're doing is we're saying we're cutting our losses before you get to that $250. We're actually going to cut your losses at $2. So hopefully that clarifies what I mean with respect to cutting your losses at 200 times your max profit, which is below the max loss in this particular case. Um, this is a question for Jess from Dominic. Besides collecting greater than 1/3 of the width to buy a debit spread, what are the optimal conditions for maximizing gains, i.e. Vega, Delta, or anything other in terms of Greeks?
Yeah, we can do this one really quickly as well. So you just want to understand how the Greeks work in your favor. And if you have a multi-leg option, you can position them accordingly. So if you have a debit spread, you want large movement. So a higher gamma will help. You want volatility exposure. So a positive vega as well. If you can make theta positive, it is rare, but the goal of a debit spread is reducing your extrinsic value exposure, because that time value is going to decay. And the way that you can mitigate that is by reducing the amount of premium that you're paying in exchange for upping your or capping your upwards or downwards potential, depending if it's a call or a put. So if you can create a positive theta, then you've reduced your time value exposure. That's very hard to do and doesn't happen. So the idea is just to reduce your theta as much as possible. But that's what you need to do for the Greeks in order to maximize your gains. But I will say that's what the OptionsPlay tool is built on. So those best practices should already be applied.
Thank you so much. The next question here is from Joe saying, please consider including the in-the-money trades to the portfolio. Joe, we are one step ahead of you. We're currently working on that. We will be publishing that very, very soon so that you can see Jess and I's in-the-money trades in a portfolio within OptionsPlay in the next week or so. Thank you so much for that suggestion. Next question is from Keith for Jessica. I sold some cover calls and I have 10 days left until they expire. I wanted to close out the trade early to resell at a different strike and expiration, but there's been no bid and the last trade was at 5 cents. What is typically the lowest someone would be willing to pay or sell for? I understand some brokerages won't charge for options trades.
Yeah. So first of all, if you have a covered call and you're trying to close it, you close it on the ask. So you're looking for an ask, which means somebody would have to have a sell order in there, and that's where it would be reflected. So if there isn't any liquidity, which happens when it gets very far away from the money, you may run into some difficulties. There is something you can place by calling your broker called a cabinet trade, where they would take it for a penny, but I've actually maybe seen that go through one time in my entire 14 years of doing this. I don't know if you've ever seen a cabinet trade go through, Tony. I'd be very interested to know. But nonetheless,
I don't think so.
Yeah, that's the only way that you can get that to close.
Thank you for that. The next question is a really good question, and really more of a theoretical question from Leonard, saying, when you have an option that's losing, do you ever consider rolling them out or modifying them, or do you just bite the bullet and take the loss? And this is something that I've spoken a lot about in terms of trading psychology. And from my perspective, if you ever want to, quote unquote, adjust, roll, repair, whatever it is that you think you're doing to try to turn a losing trade back into a winning trade, what I suggest for you to do is close out your losing trade first and then decide whether or not you want to make that adjustment, because an adjustment is really just placing a new trade. Let's not sugarcoat it by calling it a roll or calling it a repair. What you're really doing is you're placing a new trade, likely adding more risk to that trade in order to do so. And almost always you're adding more risk to that trade. So, and what you're doing is you're basically closing out an existing trade and adding a new trade. And many times we tell ourselves that if we're just doing it as a single trade, that we're just trying to improve our portfolio by repairing or doing something that's going to get a loss back into a winner. But the reality is you're just taking on more risk, hoping to get yourself back to break even. And psychologically speaking, we tell ourselves that in order to take on more risk to try to get ourselves back to break even. So my best advice to you is if you're in a loss and you're thinking about rolling it or adjusting or doing something to it, close out your losing trade first. Then ask yourself, would I be getting into this new trade that I'm supposedly is going to repair my old trade if I wasn't already in a losing position? I tend to find that the answer 9 out of 10 times is no. I would not get into a brand new position in that particular stock. But sometimes I do. Sometimes I have a losing position and I choose to get out of it. And I think to myself, well, you know, the timing on that old trade was bad. I think the timing on this new trade is better. So I'm going to stick my neck out and place a new trade. But when you break up that trade, when you break the psychological connection between the losing trade and the new trade that you're trying to do, most of the time you're going to say, it's not worth risking more money on this trade now. because I was only willing to risk more money because I was losing money on the last trade. So when you break it up, you tend to find most of the time you will bite the bullet and just take a loss. Occasionally, you will make that adjustment. That's my view, and hopefully that answered your question, Leonard. Next question is for Jess from Arlene. Please elaborate on choosing either to sell a call or buy a put. This is a good one. Did I just lose my internet connection, or did Jess just lose her internet connection?
Yeah, and Tony, I may need you to step in because I think my internet is being.
No problem.
I think it's me. Can you hear me? You can answer. Go for it.
Okay. What's the best way to adopt a directional view on a stock? Stephen, there are infinite number of ways to adopt a directional view on a stock. I happen to use technical analysis and some of the tools available to me as a technical analyst. What I would say that, one, there's no such thing as a best way. If there was a best way, everyone would be using it. No one would use anything else. Second of all, use something that you understand, right? Whether that's technical analysis, whether that's fundamental analysis, whether it's a specific technical indicator, learn it and master it. And what I suggest to you is stick to it. Learn it, master it, and stick to it. Don't look at all the other indicators that are available to you on a charting package. Look at the one that you understand. And if you use the same one day in and day out, that's when you're going to get a lot more consistency from your trading. So hopefully that helps provide a little bit of an understanding. Jess, I think you're back. Let me know if you're not, but the question here is for you from James asking, explain volatility crush. I showed 150% loss on my CNA trade, even though I was up 72% the day prior, and the stock was up 10 points from where I entered.
I am back, yes. All right, I also love this question as well. So whenever you have a likelihood of an anticipated movement in the security, that extrinsic value component that is implied volatility will go up exponentially prior to earnings. Now know that the definition of implied volatility is a likelihood anticipated movement. Once earnings are reported, that likelihood of an anticipated movement is completely removed because we know the outcome, which means that expensive part of your premium is also gone. So that's why we call that volatility crush, because right after earnings reports, that extrinsic value component of the options premium is completely removed, which means you need a very, very large directional move to be profitable if you just buy a call or a put right before earnings. So it's better to take a directional view and layer on a short call or a short put. That way you can reduce your extrinsic value that you've purchased if you are going to play earnings and never do it the day before.
Yeah, it's really important to understand how the Greeks affect the value of your options, because Vega is what we're referring to in terms of volatility crush. And that's really, if you want to learn more, learn about Vega. Livy's asking a great question. Sometimes it takes time to get my orders filled, and I don't understand why. Can you give me insights on possible reasons and tips for a more efficient trade? Livy, absolutely. First of all, liquidity is the most important thing to help you better understand how fast you can expect an order to get filled or not. And that's why whenever you use OptionsPlay, any symbol that you type in will give you a ranking, 1, 2, or 3. Anything that's very liquid, when you place an order at the midpoint or within just a couple of pennies of the midpoint, you should expect an execution within no more than a few seconds. If you're not getting that execution within a few seconds, that means the market has moved well away from the price that you're trying to get filled at. If you're trading something that's somewhat liquid, I tend to have to move my prices at least about perhaps 5 cents off of the midpoint in order to get a quick fill. And then if something that's not liquid at all, I won't touch. So likelihood, when something is just sitting there, it's not getting filled, one of two things is happening. The market has significantly moved away from your price and it's not going to get filled regardless of the liquidity of the underlying, or you're trading something that's not very liquid. Those are the two things that I suggest that you look at next time you place a trade. If you're trading something very liquid, like I said, you usually don't have to move more than a couple of pennies off the midpoint in order to get filled on most of your orders. Can you explain to me how to protect my portfolio during down markets? How to protect my portfolio against inflation? let's try to tackle this one at a time. Protecting your portfolio against a market downturn. I have hosted a whole session just on that alone. My view is first thing is move to cash. Second thing is perhaps look at hedging using futures, and the last resort that you have is using options to potentially hedge your portfolio. There are better ways to hedge your portfolio than buying puts on the market. As far as how to protect your portfolio against inflation, one, I don't necessarily know that you need to protect your portfolio against inflation. Being long equities is one way to potentially protect your portfolio from inflation, but I don't necessarily agree that you need to protect your portfolio from inflation. You might want to protect other things against inflation, but certainly not your portfolio. You can buy inflation-adjusted bonds is one way you can potentially do that as well. Jess, I don't know if you have anything to add to that.
Well, I think diversification is key. And there are certain sectors that are impacted by high interest rate or inflationary environments. And so one way is just adjusting your portfolio allocation to perhaps be a little more defensive, if that's something you're concerned with. However, it also depends on your time horizon as well. So if you don't need the funds in that portfolio and it's just literally equities we're talking about, don't sell them at the low.
Perfect. Here's a really good question from Atif saying, do you use the same technical indicators for futures as with stocks, or it depends? For example, with ES futures versus SPX index. So to answer the first part of your question, the answer is yes. The whole value that I see in technical analysis is that you can apply the exact same indicators, the exact same methods to any asset class and any single time frame. So whether I'm looking at the S&P, whether I'm looking at bonds, whether I'm looking at commodity, and whether I'm looking at an index or a future or a stock or ETF, I'm using the exact same analysis. That's the point of technical analysis, or at least that's the value that I see in technical analysis, right? Let's say you're a great fundamental analyst and you really know your way around financial statements, and you can really get a good sense for the value of a company from looking at fundamental analysis. You unfortunately cannot apply that skill set to analyzing the market. You can't analyze commodities or interest rates or anything with that. And that's really the limitation that I see with fundamental analysis. It's really statistical and technical analysis that gives you this holistic view across any single asset class. And not only can you do intermarket analysis, which is very important, in these days, since markets are so interconnected, you can also do it on multiple time frames, right? So technical analysis, you use the exact same technique on a 10-minute chart as you do with a weekly chart. Now, I will say, for me personally speaking, I never go to a lower time frame than a daily chart. I never go to a 4-hour chart or a 10-minute chart. I will look at minute charts just to get a sense for what the intraday action is, but I'm not using those minute-based charts to day trade per se. But that's just personally me. I did come from a day trading background, from a futures trading background, but in those days I actually used tick-based charts. So basically, instead of using a time-based chart when I'm trading intraday, I used a tick or a range-based chart, which means that the x-axis was not based on time; it was based on something else, because time is sort of arbitrary. In terms of how each bar progresses. And when days are very volatile, or rather in the beginning of the day when there's a lot of volume, it's the same interval as kind of in the middle of the day when there's not a lot of volume. So I used kind of a tick-based chart for intraday if I was day trading, but I'm no longer a day trader. I only use daily charts, weekly charts, and occasionally some monthly charts. But to answer your question, same indicators across all asset classes and same indicators across all time frames. And Jess, I know you use a lot of technical analysis in your trading, so feel free to weigh in as well.
Oh, I loved your answer. I actually do not look at anything less than a daily chart as well. So I'm glad we have that in common. Yeah, I think it's important, especially with these volatile times. Even going back and taking out the noise and going to a weekly chart is arguably even more important. So completely aligned on that. Good stuff.
Thank you. So I will leave the last question here to you, Jess. And this is a question on kind of the markets. We kind of shied away from doing specific examples, but I thought this is one that's probably relevant to a lot of investors. Saying this person is saying, I'm getting short in the XLE, the energy ETF. Is the energy sector due for a correction after 26 weeks of domination, or is the sky really the limit?
Yeah, and I don't know what our opposing views are, if they are aligned or not. So this should be a fun one as well. So glad we're ending it here. Yeah, so energy to me, it has been an overcrowded trade, but know that unless there is some type of fiscal policy intervention of some sort, there is still lots of room for energy to go up. And if you even looked at the CPI print today, that is still something that's going higher. Futures are adjusting as well, but there is certainly room to the upside because there is a supply constraint. And if demand outweighs supply, then there absolutely will be movement for the upside.
Yeah, and I just pulled up a chart here of XLE relative to SPY. This is a long-term chart here, but obviously we've seen this large underperformance. This is the 26 weeks of outperformance this person is referring to in XLE. And what we've seen is that recently XLE continued to break out higher relative to the SPY, pulled back here. So I actually think that we're at a pretty pivotal moment here. Energy can either start to underperform, as this person is suggesting, and if it does underperform, I do think that there's quite a bit of underperformance here potential for XLE to pull back here into this range. But at the moment, I still think that this energy outperformance will likely to continue. We can at the prices that gas prices are, crude prices are. These energy companies are generating an incredible amount of free cash flow, and they are returning that free cash flow to investors in the form of dividends and share buybacks. This is something that no other industry out of the other 10 sectors are seeing, this type of free cash flow growth and being able to return cash to investors. And because of that, that is the only reason why I think that this industry, at least for now, will continue to dominate in terms of outperformance relative to the S&P 500. If you strip out energy earnings from the S&P 500 right now, the S&P 500 is already in EPS contraction. It's only energy that's carrying the S&P 500 into EPS growth for 2022. Without energy, we would actually see 2022 have EPS contraction. So that is just how big of a contribution energy currently has to the S&P 500 growth at the moment. So for those reasons, I believe that there is still further upside for energy in the short run.
Aligned once more. There is one more question I would like to answer. Sorry.
Please do.
So sorry. When my internet cut out there, Arlen asked a question about selling a call versus buying a put, and you put it in the chat. So I want to make sure that we cover it. So first of all, those are two very different risk profiles. Selling a call individually is unlimited risk, because you are obligated to sell the shares at the strike price. And normally that obligation is going to kick in when the underlying security goes well above your strike price, which means you would short the shares at a lower price and could buy them back at a negatively high price. So really I would shift that towards, is it a credit spread versus where I would offset that risk potential versus buying a put or a debit put spread. The way that we would look at that is if the premium is expensive or not using IV rank or percentile. If the premium looks expensive, then that's when we would want to take a position where we sell and capture credit. And if it's less expensive, then that's where I would want to buy a put or do a put vertical. So that's one component of it. The other is, are you largely directional or are you neutral to bearish in this scenario? Because if you're buying a long option, you have to overcome the time value that you purchased. So you are very directional. You anticipate a sharp movement to the downside. Whereas if you're just selling a call, and then maybe you have a call at a higher price to offset that risk potential, you just need the underlying to be directly below your strike price and literally only by a penny for it to be profitable. So one component is, what is your directional view? Do you feel like there is a sharp movement, or are you neutral to bearish? And then are the options expensive or not? And that will decide if you should take a credit position or actually buy the debit spread.
Thank you. Thank you so much for that clarification. I think that's a really great question about option selling versus option buying, because that's really the crux of the question that you have to answer as every single time you place an options trade is, do you prefer to be predominantly a buyer of an option and what the risk profile is with that, and whether you want to be an option seller and what the risk profile with that. And arguably you can kind of have a best of both worlds by trading spreads. But this is actually, Jessica, something you're going to be covering in your first session during the wheel strategy course that we'll be doing next week, on Tuesday. This is the trading summit that we are hosting with Jessica and I, Rick and Prakash, on Tuesday, November 15th from 12 p.m. to about 3:30 p.m. Eastern time, where we're going to teach a master class on the wheel strategy. And Jess, you're going to be kicking that off on intro to option selling, talk about the benefits and the risk profile of option selling. So for those of you that want to learn more about this, please join us during that session. We have a promo for everyone that is joining for us today. The promo code is AMA. You can point your QR code, you can point your phone at that QR code and get access to this course with a 50% discount, $100 off of the course. Normally $199, you're going to get it for only $99 using that promo code, the AMA, during today's session. So I think Philip just posted the link into the chat window as well. So whether you want to click on that link or point your phone to that QR code, we have put a lot of work into this wheel market, a wheel strategy masterclass. So many of you have been asking us about the wheel strategy and kind of how to actually utilize it in your portfolio. So we're going to do a deep dive talking about option selling, talking about the strategy itself, how to manage these trades once you're in it. And Rick is going to give you his view as to how to select stocks for the wheel strategy. That is a very common question that we get here as well on the wheel strategy, is what stocks should I use to incorporate for the wheel strategy? So that is all included in this $99 course that we are running next Tuesday on November 15th. So I hope many of you will be able to join us for that session, especially for those of you that found value in what we hosted today in this AMA session. And just a last recap for those of you that are new to OptionsPlay, if you want access to any of the tools that Jessica referenced during today's session, we have a free 30-day trial for OptionsPlay that you can sign up at optionsplay.com or point your phone to the QR code in the lower left-hand corner. You're going to be able to get access to our full OptionsPlay platform. Jessica and I are continuing to teach every single Thursday and helping you master your process. And that's not going away, even though we are running these master classes that are in addition to what you have as your membership. And Rick is here to help you time your market and giving you that view of the broader markets and keeping you with the bigger picture. So all of that is included in your free 30-day trial at OptionsPlay.com. So with that, that covers what we wanted to share with you here today. Thank you so much for your time. Thank you so much for your submissions, for all of your questions, your fantastic questions. And I hope that Jessica and I did a good enough job at selecting questions that most of you can find some value in answering those questions, so that you walked away today with a little bit more insight into how you can approach options for your portfolio. With that, thank you so much. And I hope you guys have a great trading day.
Thanks, everyone.